Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in today's episode, I want to talk about Russian energy and ask the question, who is still buying Russian energy? Now, I've got some really great data to share with you today. We've got some detailed information on all of the countries who've been buying energy from Russia in the first 100 days following the invasion of Ukraine. So that invasion started on the 24th of February, and we've got data that runs through to the 4th of June. And this is going to be really interesting to look at because we'll be able to see which countries have still been handing over large amounts of cash to Russia throughout that period, and also to see what the breakdown is in terms of what they're buying. We'll have a look at which countries have reduced their energy purchases the most over that period. Because of course this was the period that the sanctions have been imposed against Russia, so a lot of countries came out and said that they wanted to stop buying energy from Russia. However, the problem we had in Europe is that a lot of the economies couldn't really afford to do it. A lot of them had been built up using Russian gas and Russian oil, and it's easier said than done to walk away from those deals because the reason that they were buying it from Russia is because from a proximity point of view it was very close, and from a cost point of view it was the cheapest in the market. So it's going to cost a lot of money to move away from Russian purchasing, but also you need to put the infrastructure in place to replace it. Because Russia has land borders and have built up pipelines to be able to distribute all of these energy products across Europe. And going to other suppliers means that you're going to have to change the way all of that energy is delivered. So there's a lot of different moving parts to this. And then I'll also go through the details of how big the increase in energy purchases has been coming from China and India. Because all the discussions now are around China and India stepping in to replace all of the previous purchases from the EU. But we'll go through the data and discuss whether or not that's realistic. We'll look at the actual volumes involved in this. And then finally today I'll wrap up with my summary as to what has happened over the first 100 days of this conflict, where we are right now, and what's likely to happen over the next 3 to 6 months, and what the impact of all of that will be on the global economy. So before we get started, as usual, I'm going to ask you for a thumbs up and also to subscribe if you haven't done so already. Don't forget, I always include chapters in these videos, so if there's a section you're not that interested in, it's really easy to skip over it. And if you'd like to support the channel, please have a look below, where you'll find links to YouTube's Super Thanks and membership, as well as Buy Me a Coffee and Patreon. This chart shows the breakdown of the countries that purchased the most energy from Russia during the first 100 days of the invasion of Ukraine, so the period from the 24th of February to the 4th of June. Before we go through the country breakdown, I thought it was worth mentioning a couple of highlights. During the first 100 days of this war, Russia earned $98 billion in fossil fuel revenue. The European Union accounted for 61% or $60 billion of that revenue, and members of NATO paid over $54 billion to Russia. This table shows the breakdown of fossil fuel revenue by the different types. And you can see that crude oil is by far the largest revenue generator, accounting for over $48 billion, which represents just under 50% of all of Russia's revenues. Natural gas brought in over $25 billion, derivative oil products over $13 billion, liquefied natural gas was much smaller, only around $5 billion of revenue, and coal came in at a similar level. So overall, oil and derivative products equate to just under 2/3 of all revenues, natural gas and liquefied natural gas around 30%, and coal comes in at just over 5%. This table shows the breakdown of the purchases by country, and you can see that China is now the biggest trading partner for Russia for all fossil fuels, followed closely by Germany. Italy is third, followed by the Netherlands and Turkey. As of the first 100 days, Poland was coming in at number 6, France at number 7, India number 8, South Korea number 9, and then we've got Bulgaria, Belgium, Greece, Spain, Japan, Austria, Romania, UK, Slovakia, Estonia, and Egypt. The breakdown of this chart is really interesting. The section on the left in red represents crude oil. The pale orange figure is oil-related products. The light blue section is pipeline gas, so that's gas that's delivered directly by pipe. The darker blue section is liquefied natural gas, and the black section is coal. So you can see that the vast majority of purchases made by China were crude oil and related products. There was a relatively small amount of pipeline gas, an even smaller amount of liquefied natural gas, and some coal purchases. The breakdown for Germany was entirely different, with the vast majority coming from pipeline gas, a smaller but still significant amount of oil and related products, and a relatively small amount of coal purchases. What's interesting about Italy is that up until now, we've been talking about Italy having a dependency on natural gas, on the pipeline gas, which is used to produce electricity. However, when you look at the breakdown of what Italy actually paid to Russia during the first 100 days, you can see that they actually bought more oil than natural gas. So they've got a really high dependency on oil purchases. And one of the reasons for this is that Italy has a refinery in Sicily which is owned by Russia's Lukoil. And due to the sanctions that were introduced, this refinery is only able to buy Russian oil because the banks were unable to extend any credit to buy other forms of oil. The Netherlands comes in fourth on the list. It was the highest single purchaser of oil products from the EU and bought more than Italy and Germany, even though the population of the Netherlands is significantly smaller, around about 18 million people. Now, the reason for this is that the Netherlands is an oil trading nation, so it buys in oil and then sells it on. Most of the oil majors have big facilities in the Netherlands, so this isn't for internal consumption. Turkey was the fifth largest purchaser of energy products from Russia, and you can see that the two major purchasers are crude oil and natural gas. And as you'll be aware if you follow the channel, Turkey have tried to take a neutral stance during this war. They're still having an open relationship with Russia. They haven't joined the sanctions. They're not party to them. They still want to buy energy products. And that's partly because Turkey is dependent upon them. It has pipelines that feed these products directly into the country. But also it's in a very difficult financial position right now. And buying alternative oil and gas supplies would be more expensive, and Turkey does not want to do that. So going forward, it wants to carry on making these purchases. It's not going to cut back Russian oil and gas deliveries. Poland was the seventh largest purchaser of energy products during the first 100 days. However, the situation has changed significantly. The breakdown shows that the purchase of oil and natural gas was roughly around the same during this period. However, as you're probably aware, Poland refused to pay for natural gas in Russian rubles, and as a result of that, Russia switched off all supplies. So Poland is no longer buying any natural gas from Russia, and it's also stated that it no longer wants to buy any oil products. So if we were redrawing this chart to show the second 100 days following the invasion, Poland would rank far, far lower than 7th. Now, France comes in at number 8 on this table, and what is interesting here is the amount of LNG that France were buying from Russia. So if you look at all of the countries above them, they are predominantly buying natural gas rather than liquefied natural gas. France has been an early adopter of LNG, and geographically it's situated quite a long way from Russia. And it also has a significant amount of coastline, so it's been relatively easy for France to be able to set up LNG regasification plants all around its coast. Now, France is one of the leading countries in the EU and NATO, and it should be easier for France to switch out all of its energy supplies to other suppliers because of its existing infrastructure and geographic location. India is number 8 on this chart, and you can see that the vast majority of imports from Russia relate to crude oil. India has taken advantage of the opportunities thrown up by the war. Russia has a declining number of markets available to it, and so offered significant discounts to countries like India, and India have increased their purchases from Russia significantly since the start of the conflict. South Korea is next on the list and is predominantly buying oil from Russia, and Bulgaria, that was ranked at number 10, was predominantly buying natural gas via the pipeline and is another country that recently had its supplies entirely switched off. It also refused to pay in rubles, and President Putin came out and switched off those supplies. And Bulgaria is now being helped out by other nations in Europe. You can see from the remaining 10 countries on this list that 8 of them are located in Europe, and all have stipulated that they want to stop buying Russian energy. And the two that face the biggest challenge to be able to do this are Austria and Slovakia, who both are fully dependent on Russian gas that's provided by pipeline to generate electricity. Japan has also come out against Russia's invasion of Ukraine, but is in a difficult situation because it has a number of joint ventures with Russia on the Sakhalin development. And you can see that Japan is the 3rd largest buyer of Russian liquefied natural gas after France and Belgium. The final country on this list is Egypt, and as you'll know if you follow the channel, recently posted a video on the current situation in Egypt. They're having major financial difficulties, and they will be looking to buy oil from the cheapest possible source. This chart shows the percentage of Russian fossil fuel export revenue in the first 100 days following the start of the war. I thought this was interesting because it gives some perspective as to how easy or difficult it's going to be for Russia to be able to switch out its current markets for new markets. So the table highlights the top 10 markets. And as you can see, China currently represents 13.5% and India 3.7%. So between them, these two countries represent just over 17% of all of Russia's fossil fuel revenue. As we've discussed in some detail on the channel, Germany and Italy are currently still dependent on natural gas from Russia for the production of electricity. And it's not easy to be able to move away from that arrangement. Neither country has the level of infrastructure in place to be able to replace natural gas with liquefied natural gas, because they'll need to set up these regasification facilities on the coast and then pipe that gas all through their existing networks. Both countries are in the G7 and both have a very prominent position in the EU. So politically, there's a lot of pressure to stop buying Russian fossil fuels. As I mentioned earlier, the Netherlands is predominantly a trading nation, and they've stated that they no longer want to deal with Russia. And the purchases in the first 100 days represented over 8%. Poland and France have also stated they want to cease their relationship with Russia, and the energy that they purchased equated to more than 5%. In aggregate, the 5 European nations listed on this table bought over $38 billion worth of fossil fuels from Russia in the first 100 days, which equated to around 39% of all of the revenue. When you add in the other nations of the EU, the total was around $60 billion. And that compares to just under $17 billion that was purchased by China and India over the same period. Now, the purchases from China increased by 55% over this period, and were also up 18% for India. So we are starting to see a ramping up. But from a logistical point of view, it's going to be very challenging for Russia to be able to replace all of the sales of the European fossil fuels with China and Indian sales. Firstly, there's the geographical challenge. One of the reasons that the European countries were buying all of this energy from Russia is because they're relatively close, so it's easy to ship it. So changing the market from Europe to India and China is going to be more difficult for Russia because they're going to have to ship these products over much greater distances. And as we've discussed before on the channel, being able to load up and move that amount of shipping is a really big challenge. Firstly, are there enough ships around? Secondly, will Russia be able to get insurance? Because the insurance market is dominated by the West. And then there's also the loading and unloading and all of the other logistical issues that will be involved in moving tens of billions of dollars worth of oil. But one of the other factors here relates to the breakdown of these sales. If you look at this chart again, the blue section relates to gas that is sent by pipeline. So this is really convenient for all of those European countries, but it's also really convenient for Russia because they're able to extract the gas and then pipe it directly to Europe. They don't have to do anything with it. If they want to now sell this gas to other markets, they want to sell it to China and India rather than selling it to Germany and Italy and Poland and Bulgaria and Austria, they're going to have to liquefy it. So firstly, they'll need to increase the volume of gas that they're able to manage. So they're going to have to set up significantly more LNG facilities, which is a big capital requirement. They're going to need tens of billions of dollars to be able to pay for this. And this is at a time when Russia has defaulted on its international debt obligations. So it's going to be difficult for Russia to be able to raise money in the international markets. Nobody wants to lend to them right now. But even if they do manage to find the funding, even if they had a partner, maybe China or India decide that they want to put some investment into Russia, it's going to take quite a long period of time to set it up because these things are complicated and take time to build. But even if Russia does find the funding to be able to build these LNG facilities, they then need to find more ships to be able to put the LNG onto to move it to China and India. So there are a lot of really big logistical headaches that Russia are facing. And the one thing that is certain is that it won't be able to be done overnight. So looking at this chart, changing all of these sales from Europe to China and India may be theoretically possible in terms of economics. Maybe there's enough demand in China and India to replace the demand that's coming from the rest of Europe. But the logistics involved in actually delivering the product is really difficult to solve and is going to take years to be able to sort out. This table shows the reduction in the monthly import volume of fossil fuel from Russia in the month of May compared to the period for February to March. As we know, most of the countries in the Western world have stated that they want to stop buying products from Russia. However, this table shows who's actually been doing it and which countries haven't really followed through on their promises. As you can see, right at the top of this chart is the USA, followed closely by Sweden. Lithuania is a country that we've featured a number of times on the channel and recently were in the press because they cut all of the supplies from Russia to Kaliningrad, much to President Putin's disgust. Egypt's ranked number 4 on this list. However, I think that's predominantly due to economics and the fact that Egypt doesn't have any money right now, so I don't think this is politically driven. It's just a coincidence that Egypt bought a lot less oil from Russia in May. And then we've got Spain, Finland, Poland, Estonia and Japan, all of whom cut their purchases down by around 50% in the month of May. Latvia reduced their imports by more than 40%, and interestingly, Turkey actually reduced theirs by 27%. But again, I think that's predominantly driven by economics, the fact that Turkey is struggling right now in terms of the amount of currency and the purchases. Because the price of oil has increased by more than 50%, that's really put a lot of pressure on Turkey, and that's one of the reasons that they had a reduction in the amount of fossil fuel imports from Russia in May. But I think what's really interesting about this table are the 3 countries ranked at the bottom. Italy only reduced its purchases by 13%, Germany by 8%, and the Netherlands by 5%. And if we jump back to the table which shows who the biggest purchasers were, 2nd, 3rd and 4th on the list are Germany, Italy and the Netherlands. Now, as we discussed earlier, there is a certain dependence, particularly with regards to natural gas. But if you look at how much oil these countries are buying directly from Russia, we are talking significant amounts of money. Germany purchased over $4 billion worth of oil products, Italy close to $5 billion, and the Netherlands close to 7.5 billion. And the percentage reductions that we've seen in the first 100 days don't really tally to the message that's being given by those countries. They're stating that they want to reduce the amount of dependence on Russian fossil fuels. However, compared to the rest of the countries on this list, they have not really shown that intent in their actions. Now, it will be very interesting to see what this data looks like for the second 100 days, because the EU recently introduced a complete ban on the purchase of Russian oil. So going forward, Germany, Italy and the Netherlands should see a massive reduction in the amount of fossil fuels that they're buying from Russia, because they'll have to source that oil from other suppliers. So what's the summary and conclusion today? Well, I wanted to post this video because it's very easy to talk about things in generic terms. And in general, the EU has come out and said, we don't want to buy any fossil fuels from Russia. We're going to stop buying oil and natural gas and we're going to find it from somebody else. However, the practicalities of doing that are quite challenging. And as we've discussed, if you're getting everything supplied to you by a pipeline, that's really convenient and it's also really cheap. And to be able to switch that out is going to cost a lot of money. It's going to mean that your inflation goes up more, and at the time when everybody's trying to get on top of inflation. So this is really bad timing, really inconvenient for Russia to invade Ukraine when everybody has high inflation. They could have waited until inflation came back down. It would have been much easier to cope with. But in all seriousness, it is quite challenging to be able to switch out from these big infrastructure projects. And what I wanted to show today is how much progress has actually been made. And as you can see from the data, it wasn't a lot. In the first 100 days, the reduction was significant from a few countries, but the big buyers, Germany, Italy, and the Netherlands, were still buying the vast majority of all their fossil fuels directly from Russia. So during the first 100 days of this war, there wasn't really a massive impact on Russia. Now, the EU is clamping down on that. So we've now seen an outright ban on the purchase of all oil. So over the course of the next 3 to 6 months, we should see a massive reduction in the amount of oil that's being purchased from Europe. Natural gas is still challenging. As we discussed earlier, it's not easy to be able to switch from gas to liquefied natural gas. You need to put all of the infrastructure in place. Germany and Italy are working on that. They've got a lot of floating LNG facilities that they're trying to bring on board. It's going to take time. It's not going to be easy. And in terms of the volumes, they won't be able to replace 100% of the Russian supplies by the end of this year. That's the target, but I think it's proving to be quite difficult. So we're seeing a slowdown in the amount of energy that Russia is selling to Europe. In terms of switching those supplies to China and India, I wanted to highlight the fact that that's going to be really challenging for Russia as well, because it's not just a case of switching one supply off and switching another supply on. they're going to have to change all of their infrastructure. Firstly, on the natural gas side of things, they're going to have to set up all the facilities to convert more of its gas into LNG. And that's going to take a lot of investment, a lot of time, and a lot of energy. So in the short term, it's very likely that if we see all of these purchases being switched off by Europe, that Russia will just lose that revenue because they won't be able to just switch it out with LNG. It's impossible to do that. And they'll also see a lag in terms of oil as well, because even if China and India have sufficient demand to be able to buy the amounts of oil that was previously being sold into Europe, Russia now has to move it to China and India. And that's going to be difficult because there aren't enough ships around, and getting insurance for those ships is going to be difficult, and it's just going to be a logistical headache for Russia. And of course, this is coming at a time when all of Europe is now needing to buy oil and LNG from other countries. So the USA and Qatar are the two big suppliers of LNG. So there's going to be a global increase in the demand for shipping from both of those nations. So the USA and Qatar are going to need to charter more ships to be able to keep moving all these increased amounts of LNG into the European markets. So Russia is going to be under pressure because any spare shipping that's currently kicking around is likely to be chartered by Qatar and the USA rather than Russia, especially because all the sanctions are still in place against Russia. So the shipping companies won't want to fall foul of those sanctions. And it's exactly the same story for oil, because the pipeline oil that's being given to Europe right now needs to be replaced with oil that's coming over the sea. So there's going to be a further increase in demand for shipping of oil at a time when Russia is trying to find ways of moving that oil to India and China. So it's a really interesting conundrum in terms of how is Russia going to find the level of shipping that it needs to be able to move all of these products to its new markets. And in terms of the overall impact on the global economy and Russia's economy, well, unfortunately, it's going to be negative. All of the things I've just talked you through are more expensive than the existing arrangements. Everybody's been sitting happily taking oil and gas directly from Russia via pipelines. And that's been great because it's been the lowest cost possible. The cost of everything is on the rise. And unfortunately, it's going to permanently change because putting all of these new facilities in place means investing a whole lot more money. And that cost will have to be covered by somebody. And it's going to be covered by consumers. Everybody's bills are going to increase because the companies who are paying for all of this will pass it on in terms of increased charges to everybody who's using their products. But it's not just the infrastructure cost. It will obviously cost more to buy LNG from the USA than it will to buy natural gas from Russia. That gas needs to be converted into LNG in the USA. It then needs to be put onto tankers. It needs to be moved all the way across the ocean. It then needs to be unloaded. It then needs to be regasified and then fed into the pipeline system for that country. All of those different parts will add cost to the process. And it's going to mean that everything is rising in price. And because a lot of gas and oil is used to produce electricity and for transport, it's going to feed through into absolutely everything. So unfortunately, we're seeing a sea change now in costs. We are getting a permanent increase in costs because of this change of supply. And in terms of Russia's economy, this is also bad news because their costs are also going to go up. They're going to have to change their gas into liquefied natural gas. That's going to involve the same process, the same investment, and they're also going to have to ship all of their energy products over much greater distances. So all of that will increase cost. So at the moment, India and China are benefiting because they're getting discount deals from Russia, and it's a really happy time for them. But overall, at some point, Russia will need to increase its prices to cover its costs. And so those discounts won't last forever. And there might come a point where India and China say, actually, the deals with Russia are no longer that attractive. We'll do deals with other parties. So there will be a long-term impact on Russia. Firstly, right now, they're offering discounts, so that's hurting them. The rise in the value of the ruble is also hurting them. I've done a separate video on the impact of the rise in the Russian ruble. Please check that out. But overall, what we're going to see for Russia here is time delays. They're going to lose revenue as they switch from supplying Europe to supplying the rest of the world. And they're going to see increased cost. And that will have a negative impact on the Russian economy because Russia is fully dependent on the sale of these fossil fuels. Over the first 100 days of the war, it took in around $100 billion for the sale of oil and gas. Going forward, it will be less, and this is coming at a time when there are a variety of sanctions being applied against Russia, so it's more difficult to do business. So the overall summary here today, unfortunately, is that what's happening is bad news for both Russia and the global economy. I know that's a recurring theme of these videos, but I'm just telling you as it is. I'm giving you the data so that you've got a better understanding as to why prices of everything are going up all the time right now. Hopefully you found this video useful, informative, and interesting. If you've liked what I've said today, then please give me that thumbs up, and don't forget to subscribe if you haven't done so already.